Once again, welcome to the Wealth Academy educational series. I'm Adam Khoo. In this session, I'm going to show you the simplest way to make money from the stock market, even if you're a complete idiot with little or no effort whatsoever. Is that really possible? Let's explore that. Before I continue, again, please read the risk disclaimer by pausing the video, and once you understand the risk, please carry on. Great. So I've got a question for you. Is it possible to achieve between a 10% to a 12% annual return from the stock market with very little or no effort? Most people say, no, I don't think so, right? If you look at most retail investors, for example, in Singapore where I'm from, the average retail investor makes only about 3 to 5% return a year if they are lucky. So they will look at this and say, impossible. How can I make 10% a year with no effort as a complete idiot? And I'm telling you that you can. How? Well, to answer that question, you have to first understand what an index is. Now, every stock market has an index that measures its performance. And the index is made up of a small basket of stocks that represents all the stocks in that particular market. For example, in the US market, there are about 7,000 companies you can buy, 7,000 stocks. So out of the 7,000 companies, they pick the 30 biggest companies to represent the rest. For example, you have got 3M, Apple, Boeing, McDonald's, Intel, General Electric, Goldman Sachs, IBM, Coca-Cola. Sound familiar? These are the 30 biggest companies in the US. So you take the average price of these 30 companies and you take that price, and it's known as the Dow Jones Industrials Average, or the Dow Jones Index. So this index represents all the stocks in the US. Of course, you've got other indices, but this Dow Jones is one of the biggest indices. Now, let's take a look at the US market over the last 30 years, represented by the Dow Jones Index, the 30 biggest companies. So if you go back to the last 30 years, you notice in the short term, the market is like a roller coaster, right? So every time it goes up, it comes down. It goes up, it comes down. It goes up, it comes down, up and down, up and down. Now, if you want, I can zoom in, right, like that, 30 years ago, and you can see the price went up, and this was Black Monday. This was a crash on Wall Street, and a lot of people lost faith. They thought the market will never recover. Some people even committed suicide. Some people gave up, and sure enough, I always say when the last man jumps off the building, bam, the market goes higher, right? And then it comes down again, it goes up again, it comes down, it goes up again, and it went all the way up, okay, with a huge bull run, and then it went through a recession over here. This was in the year 2000 to 2002. Right, this was the dot-com bubble crash together with the 9/11 terrorist attacks over here. And then, sure enough, when everyone gave up hope, they said the market will never recover. You know, I lost all my money. They gave up on the market went even higher, as usual. And on October 2007, we had the subprime financial crisis when Lehman Brothers collapsed. And the stock market collapsed by about 55%. It was one of the biggest crashes in history. And sure enough, when everyone thought that the US market will never recover, that was the end, boom, the market went higher again to 18,000 points. And recently, because of the crash in China and oil price collapse, we're down to 16,000 points. But nonetheless, if you look back from where we started to where we are, think about it, there was a huge increase. So the point is this: in the short term, the market's volatile. It goes up and down like a roller coaster. But in the long term, it always goes up. In the long term, the market makes higher highs, as you can see, higher high points, and higher low points. So the question is, this has happened for the last 150 years since the market began. So the question is, 10 years from now, 20 years in the future, would the index be higher than it is today? And the answer is a guaranteed yes. Now, why is it a yes. I mean, why can't it go down and never come back? There are three reasons why. The first reason is inflation. So you can bet that 10 years from now, a Big Mac would cost more than today. 10 years from now, a Nike shoe would cost more than today. So even if companies don't grow, they sell the same number of shoes and burgers, because each item is priced higher, their sales revenue and net profit will be higher because of inflation. Hence, the value of the company, which is based on earnings and profits, will definitely be higher. And stock prices always adjust to profits and earnings. The second reason is population growth. So you can bet 10 years from now, there'll be more people on Earth. Because more people are born than people die. So more people means more demand for goods and services. So Nike has to sell more shoes. McDonald's has to sell more hamburgers. So the companies have to keep growing to supply a bigger population. And hence companies will always grow indefinitely. But you say, but Adam, don't some companies die? And don't some companies go bankrupt? Well, here's the thing. Index changes. The 30 companies that make up the index are not always the same 30 companies. They change all the time. The moment a company does not do well, is losing money, it gets kicked out of the index and replaced by a better company. So for example, Citigroup, AIG, General Motors, they were in the Dow Jones about 5 years ago, but they've got kicked out because they're not doing well, and they're replaced by, Apple, Nike, Visa. And so it's always the best 30 companies that represent the market, that make up the index. And that's the reason why the index always goes higher. So if you know that the index will always go up in the long term, not a stock can drop and never recover, but the index will always go up, what could you do? Well, simple. Buy and just close your eyes. Because imagine 30 years ago, in 1986, if you bought the 30 companies in the index and you closed your eyes and it went up and down, you didn't care, you just kept holding on, right? And you open your eyes today, would you have made money? Yeah. How much would you have made? You have made the gradient of this line from roughly 500 points on the Dow Jones to 17,000 points today. That's a 991% increase in your wealth. If you annualize it on an annual basis, that's an 8.34% annual capital gain, together with a dividend yield of about 3%, that's about 11.84% annualized return for 30 years. So that answers my question. Can you make between 10% to 12% annual returns with no effort? And the answer is yes. You just buy the index and you hold it for the long term, riding the ups and downs. Specific year-to-year gains and losses on the US markets. This is the S&P 500 over the last 65 years. And the S&P 500 is just another one of the indices that measures the US markets. And it moves together with the Dow Jones. So you can see in 1957, the market increased by 16%. The next year, it went up by 11%. And next year, it went down by 6.7%. You can see over 65 years, there were more winning years than losing years. And that is why, in the end, you always make money if you hold long enough. Now, what if you just held for a year? So imagine if you bought the US index in January and you sold it in December, just held it for a year. And you did it randomly, right? With no strategy, you just threw a dart. What's your chance of making money? Well, out of 65 years, you can count there were 13 losing years, which means statistically, your chance of making money over a 1 year period will be 74%. Your chance of losing money will be 26%. Is that good? Hey, that's not bad, considering the fact that there's no strategy. It's pure random chance, luck. And that's better than any casino game you can play. So I don't understand why would anyone go to the casino when they can get at best 50-50 chance of winning. When in the stock market, you have a 74% chance of making money purely through luck, holding it for just 1 year. Now, if you held it for 2 years, 5 years, 10 years, 15 years, it's 100% chance of making money if you hold it long enough. Now, again, this doesn't apply to one stock. The stock of a company can drop and never come back, but the index will always go high because it's the best 30 companies, which they change all the time. Now, the same thing applies for any other market. This is Singapore for the last 28 years, and you can see if you bought it 28 years ago, riding the ups and downs of the financial crisis and the dot-com crash, and you open your eyes today, you would still have a gain of about 7.28% annualized return. Not as great as the US market, but still a positive, better than the fixed deposit rate you get at the banks, right? That's the Malaysian market. Over the last 18 years, the annualized return is about 8.88%. Of course, you have to factor in the currency as well. So if you invest in Malaysia, this would be in the ringgit. How about Indonesia? Well, if you bought the Indonesian stock market index for the last 18 years, and again, you rode the ups and downs, you would have returned 16.26 annual return for the last 18 years. Again, this is in the rupiah, so you have to adjust for currency as well. And finally, the Hong Kong market returned roughly about 11.3% over the last 18 years to 2015. So what's the lesson? Lesson is very simple. You can potentially make, based on historical performance, between 10 to 12% annual returns with little or no effort. Even if you're a complete idiot, simply by buying and holding the index for the long term. And so far, the US index has given the best performance as compared to any other index in the world, especially when you factor in the US dollar. So how do you buy the index of the different markets? Well, we buy the index using exchange traded funds, or ETFs. So in my live trading courses, in my online trading courses, you learn exactly how do you buy the ETFs. You know, what brokers to use, what price to buy them at, what prices to sell them at. Back in 2006, I was one of the first people in Singapore to actually promote ETFs, or exchange traded funds, buying the Singapore STI ETF, the US Dow Jones ETF. And I was featured on the Pulses magazine by the Singapore Stock Exchange. I was one of the first people to teach about ETFs. Now, let's look at the last 7 years, from 2009 to 2015, to end 2015. This is the Dow Jones ETF. And you can see 7 years ago, it was selling at roughly $70 per share per ETF. And if you bought it at $70 and you just held on to it, today it's worth about $175 per share. That's 150% return over 7 years. So if you analyze it, it's about a 13.98% return, which again beats your fixed deposit rates at a bank any time of the day. Now, if you're wondering what a 10 or 12 or 13% return can do to your wealth over the long term, check this out. A 12% annual return will make an average income earner a millionaire, even if you're a complete idiot without much effort. Let me show you the maths. Let's assume an annual income of $60,000 a year, or $5,000 a month, you know, a household income, if you will. If you work for 30 years until you retire, that is $60,000 multiplied by 30 years. That's $1.8 million you have earned in your entire lifetime of working. But for most people, they won't see that 1.8 million. Why? They spent it all away. They say, I don't have time to save that money. But what if you were to just save 10% of your salary? Is that possible? I'm sure it is. So imagine every year you save $6,000 and you invest it in the index ETF. And again, the US markets have given the best returns. You just buy the ETF, you close your eyes, you hold it for the long term, all right? And you let it compound at an average of 12% a year, all right? how much would you have at the end of 30 years? Well, 6,000 a year compounding at 12% for 30 years becomes $1.6 million, which is almost $1.8 million. And what that means is this. It means if you just invest 10% of your salary into the index passively with no effort, you make back close to 80% of everything you've earned in your lifetime. And that's the power of compounding, and that's the power of the stock market. Now again, I'm not saying that you can only get 12% or 10%. I'm saying that 10 to 12% is a passive method with no effort, even if you're a complete idiot. But if you put in effort and you learn how to be an active investor with the right strategies, you can make a lot more than 10 to 12% return. You can make double or triple the amounts. But those are in my videos to come. So for now, this is Adam Khoo from Wealth Academy. I hope you've learned something. Take care and I'll see you soon. If you like this channel, do subscribe to this YouTube channel.